Welcome to the live stream. It is Sunday, June 22nd, 2025. It is the Sunday night before the market opens next week. Next week will be the full week, the last full week of June. And this weekend there was plenty of news surrounding the U.S. bombing of Iran, targeting, I believe, the nuclear development sites that are believed to be in Iran. And that certainly created news for the market to digest, principally around oil. Is oil going to go up? Is it going to go up substantially? That's the big question. As oil goes up, stocks will go down. And looking at the last month, oil is up 24%. Oil was trading in the low 60s a month ago. We're up to $75.99. Today, oil is up close to 3% on a Sunday night. Tomorrow, we could, I don't know where that's going to go tomorrow. Can it go up a little bit more? Absolutely. I saw somebody comment that oil could add $5 per barrel, just due to the risk factor that now exists in the market. That definitely could be the case. We have the market's already reacting. The NASDAQ going down about 0.59%. The S&P futures down 0.46%. And then the Dow down 0.42%. So we're seeing the markets digest the fact that there's more risk in the market. That's just a reality. And there's already articles, right? And I think the concerning stories will start coming into the picture. So if we have a war shock, specifically a war shock in the Middle East, where the Middle East produces a lot of the oil that's consumed in the world, and that creates an oil spike that could really do a lot of damage to the global economy. So this story came out of CNN, and this is where I read that there could be a $5 per barrel increase heading into this week. So far it's about not quite $5. It's more like less than $3 of an oil shock. Now this all comes during a time that I believe the markets are doing great. Over the last 3 years, this is a 3-year heat map. You've seen stocks like NVIDIA go up 805%, Microsoft 92.7, Meta's up 316, Netflix 600, and really just great appreciation out of certain stocks. That's great, but the market just is feeling like it's a little expensive. And when we look at the fear and greed index that CNN puts together, we're reading that we're just coming off the greed measure, and that's where we were a month ago and a week ago, and we're going back into neutral. I think it's the stories around the conflict in Iran, conflict that's affecting oil, and this can really come down, which I believe is going to be maybe some good medicine for the market to take. If we have stock prices come down a bit and not really test those highs, we've seen stock prices go up and up, but they're coming up on testing the all-time highs. Let me show that to you. So we got to the all-time highs here on the S&P, and right now we're trading at 59.67. So we are near those all-time highs. So if we can back off, that'll probably be good. That means that, hey, market's probably going to wait a while before we go higher. It's probably going to wait till we have a better environment for the economy where stocks could go up just based on the expectation that there's going to be better growth, better profits, better cash flows, and so forth. It shouldn't be with the potential fear that, hey, we're going to have really expensive oil. If we have expensive oil, this S&P should go down 10%, maybe 15 or 20. So that's where we're at with this, with the stock market. What I thought would be interesting to do on this live stream, considering that the market is doing overall well, I'm performing well this year. The S&P is only only up a couple percentage points, but I showed how some stocks are just really expensive. We'll take a look at a list of overbought stocks, and we'll look at a list of oversold stocks. I'll tell you why on each list. We'll kind of look at a few examples. The intent is to see some examples of how oversold the market is or how overbought the market is. And let me rephrase that. Its intent is to show some stocks that are overbought, kind of giving more evidence to an expensive market. And the list of oversold stocks, ideas of maybe where an investor can find good value, good companies at a good price. Before I jump into that, let me say hello to Cream Biggins. How are you? You want to take a look at Cart and JD. Yeah, we can look at those. Instacart and JD, the Chinese e-commerce company. I can look at both. And good evening to you. Hopefully you're doing well. All right, so let's take a look at the overbought stocks and kind of show what is overbought. RSI, as we get closer to 100, that means that they're severely overbought. As we get closer to 0, that means they're severely oversold. So based on RSI alone, we're going to look at these stocks that are listed. And I'm not going to look for small caps. I'm going to look for some bigger caps because some of these small caps tend to be such low float that any type of pickup could really show a big measure. So I'm going to look at a couple like Liu. Let's take a look at this one. This is a $3 billion market cap. I'll take a look at DCO. Here's a 13 billion. BWX, I wonder what they do. There's a lot of investors going into this stock. That's interesting. Micron, that's a big cap. This one is overbought. Let's take a look. That's the biggest I've opened up so far. Let me open up one more. Try to make it a big one. Roblox, that's overbought. Interesting. I think most people know what that one is. All right, so let me start with the stock that I know most, and that's Micron. So Micron, 138 billion. Over the last month, it's up 25%. Year to date, it's up 46%. So this has been in rally mode. It's had some big volatility. This stock sold off, and now it's risen in 2025. Okay, so 138, 31 billion. What Micron provides, these guys design, develop, manufacture memory and storage products in the US. So they're a big memory producer. And they are doing well because of that data center build out. Their microprocessors are needed for the data center build out. The PE is 29, and then forward P is 14. It's a strong buy with just a 10.7% discount. And I think the appreciation has made that discount smaller. The growth looks really good, 71%. So investors are really going into the stock. Look at this stock, it's cyclical. It goes up, comes down, goes up, but they're really doing well at this time. That's really good growth. The quarterly looks good, although the percentage appreciation or growth isn't as high as the 3 previous quarters. The compares are getting harder because the numbers are getting bigger, but the growth looks really good for the company. Micron, wow, they're doing really well. So as we look at let's take a look at their gross margins. and free cash flow. So low free cash flow, not a lot of free cash flow. And the gross margins are low. They're very erratic. Look how they was negative, low. 34% for a technology company, that's kind of low. The profitability is decent. The free cash flow is really low. They've never been a really good cash flow generating company. This one here would be a total pass for me. I'm just not seeing evidence that they generate a lot of cash. I use cash as a primary valuation metric just to remind you the type of investor that I am. And I'm really following in the footsteps of Warren Buffett, Benjamin Graham, Pat Dorsey, who believe buying really good business is a great idea. Businesses that have moats, competitive advantages against their competition. They also have the ability to generate free cash flow and grow it. And that free cash is the principal valuation basis to value a company and establish a stock price by looking at all free cash flows in the future, trying to get to a net present value. And that's what I do to value companies. And if a company like Micron doesn't produce a lot of free cash flow, I just can't, I can find better alternatives for myself. The fundamentals need to be there. I can really believe in a company's story, but the fundamentals need to be there around free cash flow, and they are not there for Micron. So this one here would be a total pass, and we'll see how investors do. Now, this stock hasn't been a total success for the last 5 years. You see this big giant pullback. It is 143% to the upside. In the 1 year, this has been a rough ride for investors. You see how the market just didn't believe in Micron, and it's now beginning to believe in the company. But it's done well for year to date. If you knew when to buy, you'd be doing really well. So that is Micron. And according to their RSI, this is overbought. So I wonder how it's going to trade going forward. This, I would agree, is overbought. I think it's priced way too high. I would price it much lower than 138 billion. I mean, the best I can do on a stock like this is probably be, I'd be stretching it like 90 billion in market cap. Just one last thing to look at. I always want to look at balance sheets, because if a company has a great idea, great business, but really a lot of debt, that's going to be a big problem. These guys don't have too much debt. They have 15 billion of debt, 8 billion of cash, so net $7 billion of debt. So the debt to EBITDA is really low. It's just a 1. I need it to be less than 3. So the balance sheet's fine on Micron. So Micron's a pass for me, and I agree that is overbought by a big margin. Roblox. Roblox is probably a stock that you guys all have heard of, because you may have played one of their games on your phone, or you've heard of them along the way. And I've certainly heard of them. I like the model they operate with, which is that Roblox just really provides the platform, and game developers use the platform to develop games, and then they distribute them on the Roblox platform. So that's a good idea. The stock has been flourishing, 184% on the 1 year. Good job. But I've looked at this stock a few times recently, and it's just, it doesn't add up. When you look at the free cash flow they produce, they don't produce a profit right now. It's just hard to get there. This is not a new business. These guys have been around for a while. They continue to grow. Top line's growing really good, but they just can't generate enough cash flow to make this company worthwhile. You see that they were going on the right track, and then they started spending a lot of money on CapEx. Maybe they weren't making enough money on top line, and they really had a setback. And now have gotten to about $876 million. If I look at this company and I were to value it, probably the best case I can get to is about $30 billion in market cap value, and they're way up there at 69. You can see that they've gone up a lot in value. Back here, they were probably about a $25 billion market cap company. And even that didn't look all that great because their cash flow is so darn low back about a year ago. So Roblox just didn't have the fundamentals, the consistency to get my capital, because I've been tracking this stock for a couple of years because I think it's a neat company. I think it's the right model, but they didn't have the right fundamentals. So I didn't pull the trigger, and that's the reasons for it. We'll see if their fundamentals keep improving. This might be a good stock to buy. According to their RSI number, they're overbought. So maybe the stock could come down a bit, maybe come down to $75 a share. And if their fundamentals improve, maybe that's the right time to buy into Roblox. But for now, I would stay out of this one. This one is overbought. All right, next one we'll go to Docu. What do these guys do? I have no idea what they do. So Document Incorporate provides engineering and manufacturing services for products and applications used in aerospace and defense. Okay. Just taking a look at their website to get more familiar with it. I've never heard of this business. It's not like the first two we covered. I had heard of those. So these guys were a hardware supply store, and now they're doing what they do. Engineered products. Okay, so they're probably an industrial stock. Industrial aerospace, okay. So it's 1.2 billion over the 1 year. They're up 38%. Over 5 years, up 137%. So this is going to be a good performer. PE is 34. Forward PE is 20. So the stock's doing well. It's fairly priced. Revenue is 789, so you're paying less than 2 times revenue for the company. Slow grower. They've been growing at 4% for 2024. Trailing 12 months has dropped to 3. So that is unimpressive. After the stock's appreciated the way it's appreciated, I'm thinking, why would investors be that excited about the company when it's a slow grower? Free cash flow isn't all that exciting. It's actually really low. Slow grower like this company's worth about 400 million. Not sure what investors are seeing. Gross margins are low. This is an industrial stock, but if you look at 3M's margins are much higher, and that's an industrial stock. So this one here has really low margins and really low profitability, low free cash flow. So this one is overbought and not worth it to me. This business is worth about 400 million. And that's even before I look at the balance sheet. So this one here, I'll leave it for other investors to take a look at because I think it's way overpriced. So that one is overbought, I agree. All right, so this one here is a $13 billion company, BWS Technologies. Okay, so BWX, $13 billion, $2.78 billion of revenue. So we're looking at 4.5 times revenue for the price of the company. PE is a little high at 45. And analysts think it's expensive by 7.7%. It is up 53% for the 1 year. It's working year to date, up nicely over the 5 years. So these are really good performing stocks, but can they keep those gains? Let's take a look. Revenue looks decent, 10% growth rate on the trailing 12 months. When we look at the full year 2024, 8.3. And before that, it was a little better, but it has been inconsistent. Okay. Now, I forgot to check. What do these guys do? BWS Technologies manufactures and sells nuclear components in the United States. And nuclear is really hot. So anything nuclear, just all of a sudden, investors want a part of it. And it may be the case that these guys do well in the future, but for now, let's take a look at their fundamentals. We're not seeing a big demand lift on their components, right? Because they were growing at 11.8% in 2023 before AI became, for the electric power generation space, before it became this big thing. And it's been growing nicely at 10%. That's really good growth, but it's not incredible growth. The most recent quarter was good, but the quarter before was bad. All right, so they do these nuclear power plant components. They have gross margins that are low. 24% is really low. And their free cash flow, 269. Okay. So a slow grower like this business would be worth about, I guess, about 2.7 to 4.5 billion dollars in value. And they're way above that. It's because they're tied to the nuclear industry, and nuclear stocks are doing really well. They're really flourishing. Stock prices are flying up because they're expected to fill the gap of the power that we're going to need. If AI requires all that power, the nuclear power companies are really going to be important and really valuable. Like I showed you the margins. The margins are low. Cash flow's low. So it's a pass. This one's overbought. Fundamentals do not get me to the stock value. Now, the last one we'll do that is overbought is Centrus Energy Corp. And these guys, they supply nuclear fuel components back to nuclear. So these guys have been around for a long time. And now that nuclear's become really hot, these stocks are probably flourishing. Yep, 185%, 355%. Take a look at their growth. These guys are growing really nicely. Very good. This one's red hot. PE isn't too bad. It's a $3.2 billion market cap company. Revenue is 471. So you're paying about 7.5 times revenue for the company. PE 29 for the current year. Forward PE 72. So let me look at their website. Okay, so interesting. So that's what they do. They're creating a lot of the components and parts for the nuclear industry. And they're growing really fast, which is impressive. So they're growing at 58%. They are a little small, but they're growing nicely. Okay. And back to gross margins are low. Man, these margins are terrible compared to tech companies. Their cash flow is growing. The best I could do is like $180 million for this company, and they're way up there at $3.2 billion. Investors are really betting that this business is just going to be worth a lot more because they're in nuclear. Nuclear is just going to have a boom period. It may, but nuclear takes a long time. Nuclear power plants are heavily regulated to make sure that they're constructed in a safe way and they don't create a bunch of like radioactive pollution. So it may be that, yeah, you're right. Nuclear is going to have a bright future, but that future is going to be built over the next 10, 20 years. And investors will have to wait 10, 20 years for the growth to happen. And that's not, I think I would be investing way too early. So I would stay away from this one. So those are examples of stocks that, have gone up in value or in price, but are way overbought. A lot of stocks, fit that category. Now, before I go to oversold, let me take a look at Instacart and JD, which are a couple of requests. So the first one is Instacart. What does Instacart do? They deliver groceries. You can go on an app and say, hey, here's my shopping list. Please get it from a local grocer and bring it to my home. It's been growing nicely. Market cap's 11.4 billion. Revenue's 3.46. Not too bad. You're paying about a little over 3 times revenue. Not bad. PE is 28. Forward PE is 23. They are growing nicely, 11%. It'd be nice to see them grow faster, but that's a decent growth. It's not incredible growth, just decent. $3.4 billion in revenue, and this is their growth rate over the last 4 quarters. When we look at their margins, gross margin 75%. You see how I was criticizing the margins that we were seeing with those nuclear companies because they were at 25. Now this is more like it, 75% gross margins. That's great. Operating margins there, profit margins there, really high free cash flow margin. That's the kind of business I want. Just a more profitable business that generates more cash. So Instacart looks good from those metrics. 3.4 billion. Now let's take a look at the balance sheet. The balance sheet on Instacart is really good. They have 1.6 billion of cash and almost no debt. Really strong balance sheet. We want businesses to have a strong balance sheet because we don't want them to ever have trouble. We want them to always do well. So their balance sheet's really good. All right, moving along, we have good balance sheet. Now, what is Instacart worth? Well, I have that stock in my portfolio. So what I'll do is show you where I value the stock. And I value the stock on 2 ways. I look at their free cash flows. I forecast their free cash flows, the cash flows I expect they're going to produce in the future. And I'm going to discount them by 9%. And I get to, once I forecast their cash flows for the next 4 years, and then the terminal value, all cash flows beyond year 4, I get a net present value of 18 billion. So it's actually discounted nicely on cash flow, really nice. And then on earnings per share, discounted by 7%. And overall, it's a 35% discount. So Instacart is discounted really well. I really like where they stack up. Now, what we can look at is desirability. How desirable is Instacart? Now, there are businesses of all types. We want to focus on a couple of things. We want to focus on a company's ability to grow, be really profitable, generate cash, but also have barriers to keep competitors from coming into their marketplace and competing against them and taking away that growth, profit, and free cash flow. So in the case of Instacart, I'm going to go ahead and rank them. And we'll scorecard them. So here's a little symbol that I use. And here's the scorecard, competition. Now I like that they focus just on grocery. And when it comes to grocery, I think they're the best known company. Okay, so that's good. They don't have an incredibly powerful network, and their balance sheet is good. The revenue growth is decent. I'm not going to give them an A because it's decent. They are an A on profitability, and they are an A on free cash flow. So overall, they're kind of a A minus, B plus student. I'm going to call them an A minus student. Now, they are probably going to fit somewhere along right there. They are desirable to me. They're desirable to me because they're in the green, because they specialize in grocery. They're going to be known for grocery delivery. They continue to grow. That's very good. They're trying to grow into other types of retail delivery away from grocery, which might open up a couple new businesses for them. But they're recognized as a good grocery delivery company. As we see now, if they were maybe a little worse in either category, they'd move either down here or up here. They'd still be investable, but so long as I get a decent discount on cart, I'd like to be a stockholder because I think their specialization is going to enable them to grow and be really successful in the future and maybe even be acquired because they are small enough to be acquired. So that's where the desirability of Instacart lands for me, and that's how I would invest on Instacart. Having said that, with a 35% discount, Instacart's a total buy for me. I'm going to keep buying that stock, build up a nice stack of Instacart stock. I currently own Amazon, Mercado Libre, and Alibaba, and I like them all because these businesses are going to be around for a long time. They're just going to keep growing and getting bigger and bigger. So that is a really good stock, Instacart and Cream Biggins. You also want to look at JD. Let's take a look at JD. So JD.com, and JD operates a supply chain-based technology and service provider in the People's Republic of China. All right. It operates 3 segments: JD Retail, JD Logistics, and New Business. Okay. So they're in supply chain in China. For the 1 year, they're not having a great year. Year to date, they're down. These guys haven't flourished like Alibaba and others, like Futu's gone up a lot, and Tencent's gone up a lot in China. So Chinese stocks have done well overall. Some of them have done really, really, really well. This one hasn't. $45 billion in market cap, big revenue. Look at that big revenue. Looks really impressive. And then we got a very low PE, forward PE. So what gives? How come the stock's not working? This is going to be in the Chinese currency. It's kind of a slower grower, 8.9%. Now when we get down to margins and free cash flow. So gross margins are really low. They're providing a supply chain service. They're not making big money on selling a technology product or providing like a Facebook-like experience where that's very profitable as well. So margins 10%. Free cash flow, this is in the Chinese currency, but it has not been growing over the last couple of years. You see that it was actually higher in 2022, higher in 2023 and 24 versus the trailing 12 months. So JD, if we look at the statistics, it's going to break it down in US dollars. And I could see that free cash flow is 4.76 billion. They're not a fast grower. So this business is worth maybe 75 billion. Yep, it's discounted. So I think I did a JD valuation. Let me take a look. Yeah. So JD is discounted. Now the piece to this one is I own Alibaba, and I don't want to own too many Chinese stocks. I own Alibaba and Futu, and I'm good owning those two stocks. I don't want to own too many of the same in China. I think I picked the good one in Alibaba, and I'm going to stick to it. This one here, if somebody really likes their business and is excited about it and believes in the JD business, it's discounted. I don't quite understand their business well enough. I understand the Alibaba business better, and I'm more comfortable investing in Alibaba. But that's the JD valuation. It's 42% discounted. So looks good there. I don't know what your thoughts, Kareem Biggins, on JD is. But you always have choices, right? In China, you can invest in JD, Tencent, Baidu, Alibaba. There's a pretty good list of stocks that you can invest in. I decided to invest in Alibaba and Futu. So thanks for asking about JD. All right, so got through 2 requests there. If you'd like to request a stock and you're a member, go for it. If you're not a member, it's a $5 super chat. I'd be happy to cover the stock just like I did on JD and Instacart. So the other list of stocks that I wanted to look at, and this one might be a way of getting an idea or two on, hey, maybe there's some stocks that are, unappreciated, but really good businesses that are discounted. Let's take a look. These are oversold stocks based on RSI. The closer we get to zero, the more oversold they are. So I'm going to ignore the small ones and try to get to some big stocks. Let's see. This one looks a little bigger. And that's Athlon. So open that guy up in a new tab. Copart. That looks interesting. Take a look at that. Brown Forman. Take a look at that one. See if I can buy it, find a big one, like $100 billion one. Here's 200 McDonald's. McDonald's is oversold. What? What is going on? Holy Big Macs. So year to date, McDonald's stock is not performing great. The 1 year, 14% rise. 5 year, 54% rise. They do pay a dividend. So that looks pretty decent. These guys are considered a staple, I believe. It's a discretionary, but, I don't think that's correct. It's more of a staple because it's affordable fast food. It's not like fancy dining, right? You can feed yourself at McDonald's for a few bucks. All right, so we got 205 billion in market cap. Revenue's 25 billion, so you're paying 8 times sales. Dividend 2.46. PE is 25. Forward P is 23. This stock is not a grower. Yeah, pretty flat business for the last 16, 18 months. You see that they've had some, this was an anomaly because with coming out of COVID, people had, they didn't want to cook at home, so they wanted to buy from McDonald's. They had a growth spurt there. Then they flattened out, had some growth, flattened out again. All right, so this is a fast food restaurant. Gross margins, 56%. That's very good. Cash flow, 6.7 billion. That is good. But it's really hard to get to their valuation with that free cash flow. I can't get there. I've never been able to get there on McDonald's. I think a reason why McDonald's is a highly well held stock is that everybody understands what they do. Everybody understands McDonald's. People have eaten there. So I can't get to their valuation. I'd probably get to like $100 billion valuation, but nowhere near 200. Now, when we look at their balance sheet, I do remember they used to carry some debt. There it is, $52 billion of debt. That's a lot of debt. Is it debt to EBITDA 3.4? I like to see that below 3. So first, I can't get to their valuation using free cash flow. Cash flow is way too low. And then they carry a lot of debt. So I'm not going to be a McDonald's investor. It's just too expensive of a stock. It is oversold, which is interesting. Year to date, I mean, it's not going down that much, and the S&P is only up like 2%. So it's not like a big disaster kind of stock. For the 1 year, it's doing okay, 14% plus your dividend. So over the 5 year, 54. I mean, I've seen worse stocks, but this one is not the right stock for me. So McDonald's, I was surprised to see it on the oversold list. Next one is Brown Forman Corporation, $12 billion. Revenue is $4 billion, so paying 3 times revenue. PE looks nice and low. Forward PE looks like nice and low. According to analysts, it's discounted. So the revenue is coming down. What do these guys do? So Brown-Forman Corporation, together with its subs, manufactures, distills, bottles, imports, exports, markets, and sells various alcohol beverages. It provides wines, whiskey, spirits, whiskey-based flavored liqueurs, ready-to-drink cocktails. Okay, so the revenue's down a little bit. Back here, when everybody was locked down in their homes, their sales went up, understandably. People were probably drinking a little bit more at home. But now they're struggling to grow. So let's take a look at how profitable and how much cash flow they generate. Their cash has come down. That's a concern. Why can't you have your cash grow? So $431 million, and they're not growing. Their gross margins are pretty good, 59%. It's very good. They're nice and profitable. So I'd probably multiply this times 20. That would get me to 8 billion, 8.5 billion in market cap value, and they're way up there at 12. This is not a good buy for me. They're down 41%. Yeah, this is not a business I want to own. They're contracting their top line revenue. They don't generate a lot of cash. They're priced a little too high, even after they've been going down in price. So this is not a touchable stock for me. Understandably, the RSI is really low because I don't know if this business is worth a whole lot. So that is Brown Forman. Dave 72, how are you, sir? You want to look at Jackson Financial? Yeah, we can look at that. JXN. Give me a few minutes just to finish my train of thought on where I'm at. Thanks so much for joining, Dave. All right, so the next one we're going to look at is Copart. This one caught my attention. What does Copart do? Copart provides online auctions and vehicle remarketing services in the United States, Canada, United Kingdom, Brazil, and the Republic of Ireland, Germany, Finland. Oh, they're everywhere. Okay. So they're doing auctions of cars, I guess the wholesale market. and you're able to bid on cars. Interesting. So if you wanted to run kind of a business where you buy and sell cars, or yeah, or maybe you're a collector of sorts and you're collecting cars, you may be a customer of theirs, or you're a big business, or maybe the used car dealerships use their software and their platform to find cars and find inventory for themselves. Okay, all right, we got it. $46 billion market cap. Their PE is 31, forward P is 29. They're discounted according to analysts. Now, I've heard that the used car market is really flourishing. If you look at Carvana and others, this stock is not flourishing. It's down year to date. It's down over the 1 year. Most recently, it's really gone down. Look at that big drop from 62 to 47. They announced on May 22nd, and they started to come down before then. Well, actually, the big drop happened on May 22nd. So their earnings were probably really disappointing. Although their growth is still there. Let's take a look at the quarterly. Yeah, the quarterly growth really went down. They were at 14, 12, and it came back down. So, okay, they're not growing a whole lot. It is positive growth. So they have free cash flow of call it 1.2 billion. And it has been growing over time. See how it's just year after year, it keeps getting bigger and bigger and bigger. That's good. Gross margins are decent, but not great. They're not 75, not 85. And their profit margins are good, very good. So this stock here is probably worth about 25 billion. If I multiply this number by about 20, we're going to get to like 23, 25 billion. Minus debt, make sure we don't have a bunch of debt. And debt is, nope, no debt, 4 billion net cash. So yeah, so maybe $30 billion in value, and they're way up there at 46. So they've done well with the 5-year, but they're not a fast grower. The cash flow is good. It's been growing. But maybe the stock price is too high, and investors are realizing it, and they're bringing the stock price down. So this one, and it has a high RSI, I guess because so many shares were sold to bring it back down from $63 a share down to 47. This one's not a good buy. It's not a good find. So that one there, I am going to pass on. All right, so let's take a look at JXN. So Jackson Financial. So Jackson Financial, through its subs, provides suite of annuities to retail investors in the United States. It operates through 3 segments: retail annuities, institutional products, closed life, and annuity blocks. The retail annuity segment offers various retirement income and savings products, including variable, fixed, indexed, fixed, and payout annuities. Okay, so they're doing annuities and life insurance, financials. Okay. So a lot of people are comfortable with annuities, and I get it. They're either they don't have the ability to, they lack the confidence to really work through numbers and be able to construct their financial future, on spreadsheets and so forth. So they like annuities where there's simplicity. Okay. So that's what we're doing here. So we got Jackson Market Life. Okay. So we do retirement planning. Okay. Got it. All right. So that's what they do as a business. $6 billion business. You're paying less than 1 times sales for the business. PE is really high in the current year, but it's going to really drop next year. That's interesting how drastic from one year to the next is going to be. So revenue growth, wow, look at that, 110%. Did they acquire somebody? Why is it 110%? So other revenue. So this tends to be like not core to their business. Their main business, they may have taken a big gain. We'll take a look at the last earnings release and see if they announced like a big gain on maybe they owned a particular asset and then sold it. See, the other revenue is really high in the last quarter, so we'll be able to tell what that is. Okay, so get back to annual. Total revenue jumped up to 7.4. Okay. So the revenue is kind of up, down, up. I don't like data that's kind of erratic because it's like hard to predict the future. It's like nice smooth data that's going up. You're like, okay, the next year is going to be the previous year times 10, plus 10%. But if you have like, oh, well, they're at 3, 3, 8, it's like, whoa, what's going to happen next? Another 3, or is it going to build on top of the 8? All right, so let's take a look at, so this is financial services. Operating margins 19%. That looks good, but they had negatives in the 2 previous years. Okay, profit margin. And their financials are confusing. So these numbers up here, you have some negative operating margin numbers, and then positive for the trailing 12 months. Then you have net profit margin, 1%. They were much more profitable the prior 4 years, before the trailing 12 months. All right. Okay, balance sheet. We're going to look at book value. This is a financial services company. See where their book value's been. They've grown book value really well. That's what you want to see with the financials, like a bank. You want to see this grow. Okay. So I'm curious to see what caused that big gain that was a non-operating gain. Was it a big investment gain? So here it is. So here's their the last quarter close. This is their financials. So assets under management, 325 billion. Okay. I'm just reading this, guys. Sorry that I'm so quiet, but trying to get a sense of their business. Okay. So they repurchase shares and they have a good dividend. Okay. So this one gives me a lot of information. It's a little too much information. Let me try to get to their financials. So this guy will get me what I'm looking for, which is just the financial statements. So, Nope, that's not it. Okay, so here's their normal business. Their normal business total net investment income 755 versus 734. So this they grew a little bit. That's normal. And here's where their gains are. So their gains on investments. And the market in the first quarter did really well. So this is, what does this represent? It represents 3 months ended March 31st. So if you recall, it was at the beginning of April that we had the big sell-off. We had a big swing downward in the market. So they had gains on their investments, and that's what led to them being so profitable and the revenues really popping up. Okay. Is that going to happen for second quarter? No, because the second quarter we had the big sell-off in April. So that may show up in their second quarter financials. All right, so they have a decent dividend. So this one here is just, so the piece, I like numbers that are really predictable, and Jackson just has numbers that are a little bit too all over the place, right? You see, like their total revenue, they're not showing me like smooth numbers. And I can understand maybe their business is fluctuating with the market, but it's hard to gauge. How do I value them? If you're looking at financial services, there's good companies in the space. I think MetLife is bigger, but more consistent than this. Like Met, they also sell annuities. How big are these guys? 6 billion. So Met's going to be way bigger, right? 6 versus 53. They pay dividend. They're profitable. They're consistent. Let's see here. Total revenues. See how their revenues are going up, not growing tremendously, but going up. 73 versus, 2018 they were 67. So this is a more consistent company. They pay a dividend. On Jackson, I mean, they could be really discounted or really priced too high. I just don't know. It depends which company shows up over the next couple of years. And it's hard to predict that because the trailing 12 months look good, but they also had like a poor 24 and a poor 23. They had an excellent 22. So this stock's kind of all over the place. So Jackson Financial, so it really ran up from 23 up to 24. I mean, 270% rise. Wow, that's great. 1 year, 15%, still decent. From their high to where we're at now, it's down 25%, which isn't too bad. This is a small cap. This stock is worth like sinking your teeth into it and getting to know it really well, because there is some positives here, right? They're making money. they just, as they get bigger, hopefully they'll get more consistent and they can deliver better financials. It wouldn't be a bad watch stock. Watch it. Maybe if it drops another 20, 30% and their financials get better so that we can better predict the company, maybe that's a better place to invest. Maybe after 2 quarters, it'd be a good stock to watch. But for now, it's too erratic. It's too all over the place. So thanks for asking. I wish I could give you a clearer kind of valuation, but this one's just a tough one. Their numbers are just really hard to predict. Thanks for asking, and I appreciate your support of the channel. Thank you. All right, so that was Jackson Financial. Interesting. Now, let's take a look at the markets before I conclude the live stream. See what's going on. So the futures markets are kind of like where we were at the beginning of the live stream. They're right around the same numbers. Looks like we're going to open lower tomorrow. Oil prices are up about 2.7%, up about $2 per barrel. And oil is up about 23, 24% over the last month. If it climbs to $100 a share, $100 a barrel, I'm going to create more cash in my portfolio, sell out of some positions, sell some shares, because I am concerned this is going to keep climbing. If it climbs, I expect that the S&P is going to have a pretty good sell-off, 10, 15% drawdown, because oil just has that impact. Just follow history. Every time oil goes up like that, the market sells off. Last time we had high oil price, 2022, went up to $120 a share, a barrel. Sorry, I keep calling it a share. So what happened in 2022 with the stock market? Well, let's compare the two. And compare against the S&P. And the S&P in 2022 went down. It's hard to see, but it went down. I think I could show it better. In 2022, the S&P went down 24.8%. So as you have increasing oil prices, last time oil price was above $100 per barrel was in 2022. That's my concern, is if we get to $100 per barrel, stock prices are going to dive. And I'd like to have a little more cash in my portfolio just to be ready if that starts taking shape. So that's what I'm going to be doing with my portfolio. If you want to know the stocks that I'm going to sell, well, I'm going to create a video for members and release that probably tomorrow morning. I'll share the stocks that I'm going to lean up on. And in some cases, I'm going to sell an entire position of 2 ETFs that I own, and I'll share that with members tomorrow. So, all right, guys. Well, thanks for tuning in. I appreciate it. I appreciate the support by members of the channel. Thank you so much. Let's see how we trade this week. Let's see where the markets take us. It's a little bit of an expensive market, so having a pullback is not, unrealistic, and maybe could be some good medicine, right? We don't want the market to get too euphoric and have these stocks, just fly up and have these crazy valuations. So let's just keep managing our portfolios, kind of taking what the market's willing to give us, trying to be smart and outperforming the market so we can keep growing our wealth. That's the goal. And I'll share my comments throughout the week with members, and I'll live stream a couple times this week. I'll see how often I can do that. So thanks so much for tuning in. I appreciate it. Everybody have a good night and good luck with your investments this week.